So friends, this is my third part video for UAE Corporate Tax. In the first and second part, I have covered when corporate tax is applicable, who is liable to tax, and in what circumstances you can make a tax group, offset of tax losses. Also discuss free zone taxability and your free zone taxability and scenario when it is qualifying income or non-qualifying income. In this video, I discuss from the point of view transfer pricing. Suppose you are making payment to the connected person, those are related party or owner or director. In that scenario, you have to follow arm length principle. So the related party definition is there. Some relationship, blood relationship. They have covered fourth degree of relationship. So for they have covered relationship definition and related party definition in which they have a 50% stake and controls and permanent establishment, foreign establishment, two or more person are connected in the same partnership or trust, etc. Those are treated as a related party. Controlled is defined significant and influence more than 20%, and this relationship is there. Suppose you are here, your all payment to up to the level of great grand parent or great grandparent, great great grandparents or grandchild is also covered. So payment to connected person without prejudice to Article 28, payment or benefit provided by the taxable person to the connected person shall be deductible only if to the extent the payment or benefit correspond with the market value of the services and is wholly and exclusively for the purpose of the taxable person. So this payment to these person should be follow the arm length principle. So this owner, director, or related of this two is treated as connected person. That is allowed only if is wholly and exclusively for the purpose of taxable person business and that correspond to the market value of service and deductible. So payment to connected person is covered in the form of payment to the natural or directly indirectly for to the ownership interest. Those are maybe connected in the form of control or connected through the related party is also covered. So you are a taxable person. Payment to connected person should be tested having regard to arm length. So payment to connected person should be market value of service or otherwise by the connected person to the taxable person to be determined prescribed at arm length principle under Article 34. So control is defined, unincorporated partnership is defined. Uh, this provision is not applicable if you are a taxable person, your share is traded through the recognized stock exchange. You are under the the oversight of competent authority in the state, or as may be defined by the ministers. So we have to discuss arm length principle in detail. Your transaction or arrangement between the related party must meet the arm length standard as specified. So transaction or arrangement between related party considered at arm length if results are consistent with result that would have been realized when the non-related party engage in a similar or transaction the similar circumstances. You must follow arm length principle. Your arm length result. You must follow arm length method. Related party in this transaction should be arm length. So there is a five method: cup, RPM, CPM, TNM, and profit split. So in case this five method not chosen, you can go for other method. So one of important thing is you can apply one method or combination of method. Suppose uh, cup method you can apply along with CPF. Combination of method is allowed in this scenario. So transfer pricing regime is important. You must maintain transfer pricing documentation. Uh, Arm length principle factor affecting choice of TP method must be made having regard to most reliable transfer pricing method. So these are factors that must be comply your contractual terms of that transaction or arrangement, says economic or circumstances in which the uh, transaction or arrangement is conducted. You must do your function analysis of your transaction, your business strategy employed by the related party. You have must go through the all the agreement entered with the related party for this transaction or arrangement. So it may be case there would be the TP adjustment. Authority would decide there should be the TB adjustment in your case. The corresponding adjustment will be made in the uh, related party also. So tax authority make occur adjustments in the taxable income of the taxable person to meet the arm's length standard shall make corresponding adjustment to the taxable income of related party. So taxable person shall make a application to the foreign tax authority, make adjustment to the transaction or arrangement involving the taxable person to meet the arm's length standard. So Article 3411 says when the foreign competent authority make a adjustment, taxable person can make application to the authority to make a corresponding impact to its corresponding related party also. This is the called ease of doing business. So GAR provision is there. GAR is invoked as per the treaty. GAR is there, but here in the domestic tax law of UAE, GAR provision is also is there. This article is applied when you are your one or more purpose to obtain the corporate tax benefit. Then GAR can be invoked. Corporate tax benefit includes you are making excessive refund, avoidance of reduction of corporate tax payable, deferral of taxes, or avoidance of other obligation. GAR can be invoked. We can deny the benefit of GAR, benefit available in the TT, excess deduction allowable. If the determination is made under Article 3, authority must issue an assessment giving effect to determination, which may include allowing or disallowing any exemption, allocating such exemption, be characterized for the purpose of decree law, disregarded the effect that would otherwise result and make a corresponding adjustment. So in this scenario, GAR can be invoked. So suppose you change your financial year since your financial year is July to June, but after coming this UAE immediately 1st July 2023 CT tax is payable. You decide to choose defer your financial year, expand your financial year, change from financial year July to June to April to March. Then GAR also can be invoked in this. Frequently, changes in your accounting policy or opening of free zone now can also be reason for scenario for invoking the GAR. So there is a capping of 30% of EBITDA for allowing the interest. But in case of you are making interest payment to the related party, action plan 4 of BEPS OECD model convention says that interest paid to the related party interest will be deductible only if there is a valid commercial substance for obtaining loan. If there is no commercial substance, just you have a park your fund for as a debt, and you are claiming deduction in respect of interest, and that related party is not paying corporate tax that is more than 9%, then it may be case your interest would not be allowed to be in this scenario. So there is a capping of 30%. Suppose you are paying 4 lakh interest, but your EBITDA is 10 lakh. So 30% of this 3 lakh is maximum allowed at interest. 1 lakh is carry forward. So there is also capping of 50% in respect of expenditure in related to entertainment, meal, accommodation, transportation, administration fees, faculty, or such other expenditure as may be decided by the ministry. So maximum 50% is allowed. So there is a non-deduction in respect of bribes, fine, penalty, or some donation or grant. Any dividend or profit distribution to the owner is also not allowed. So corporate tax, obviously, you are charged corporate tax to the P&L. Definitely, profit is taxable on the profit before tax. So this is non-deductible expenditure. So basically, UAE in the UAE, everyone has to register themselves for the purpose of corporate tax applicability. But in case of BAT, there is a voluntary registration if your sale is between 1,87,000 to 375. But here is no basic threshold. Everyone has to register themselves with the corporate tax authority. So tax grouping is 95%, but in case of VAT is 50%. P concept is there. So free zone is qualifying income is liable to tax. You have to maintain 7 year documentation. So this is more or less the corporate tax. So hope so, guys. My all three video is in combined nature will summarize you why and you are liable to pay and in what scenario your tax is liable to pay. So let's I conclude. Hope so you satisfied. This my disclaimer. The opinion given in the article is my individual opinion of, and it is up to the reader to evaluate their position, taking the provision of the law, applicable fact and their circumstances. Your fact and circumstances may be differ. You have to take a legal advice before taking decision on this video. Take decision on the subject matter. Author cannot be cannot responsible for any